Hey, welcome back to Watch Your Six. I'm your host, Jason Edwards. Nice to have you back. Hope you enjoyed our previous podcast. We've got a lot of information flying back and forth the last couple of weeks, so we figure we'll just dive right into some of the components. One thing we want to dive into is the benefits and the effects of social media. Obviously, we use social media to get information out. However, remember, not all information is accurate information. There are a lot of different things that are flying around the internet, so we always recommend people to do their due diligence. Social media is a great outsource and a great resource for information to get out that maybe traditionally didn't get out due to a number of things. One, maybe bandwidth, financial capabilities. For example, in the world of alternative medicine, there are a lot of new techniques and technology that's getting out there that big pharma had the resources to advertise, but they didn't. So that's a good thing. And you've got financial data, and data travels very fast. But you also notice some of the information you're learning about how you can have propagated data, informational points or data points that can make you think, wow, this is a great investment, or that's the route I should go. And when you do your due diligence and you look a little bit further, you realize that it's sort of a false hope. So we want to make sure that when you're looking at social media, using those resources, just like we are here talking to you, that you always do your due diligence, that you make sure you talk with your team. We always talk about Watch Your Six from a perspective of having someone watching your back, ensuring that you're not going to make a false step. So don't get caught up in, hearing one little 30-second pitch and saying, that's the rabbit hole I'm going to go down. Make sure that you look at all of the investment strategies, and from a broad perspective, understand that you're going to be investing, whether it's in your business, whether it's in yourself, or whether it's in your portfolio, long term. And that's a reality. And that's something you have to think about. We know recently there's been a lot of buzz, for example, of the AI sector. And that's created some trepidation in investing in the AI sector, because it seems like right now a lot of these earnings are coming from inflated numbers. So for example, you have one institution giving money to another institution, that institution giving it to another institution. So these billions of dollars seem to circulate, and it sounds good on paper, but really all they're doing is passing around the same amount of money. So when you run into those scenarios, that's when you take a deep breath before you make any decisions, and you sit down with your investment group and you make sure that you are looking from a perspective of analysis, due diligence, taking your time. We talk constantly about looking at the backside of an investment, looking at the negatives and positive investment. And recently, we've heard a lot of data releases on certain AI companies like NVIDIA or OpenAI, and they've got revenue streams coming around, but those revenue streams are really just the same dollars being passed around. Now, is that a good or bad thing? Well, that doesn't necessarily mean it's a bad or good thing, but it's something you need to know. And that's something that has been a concern for the economy, because many people felt the AI tech bubble, if you want to call it that, was inflated because most of the money was being built off of money being pushed through different companies and the creation of what they call data source areas or data centers. However, what's interesting is over 40% of that sector's growth is not based on those areas. It's actually individual companies buying computers, for example, buying technology to keep up at the speed of AI, having the resources to morph or to adjust their model. So when you have that kind of sustainable hardware build out or buy, that means that that company or that sector rather is still pretty profitable, that it's fairly what we call diverse, and you've heard the word diversification. So that's just something we want you to be careful of. Again, when you look at 30-second blurbs, don't buy into it and say that's fact. Take your time. Now, we wanted to talk a little bit today about the economy. And what's interesting about the economy is many people have felt, wow, with AI dynamics going on and tariffs and world disjointments, there's going to be scenarios where we felt, and many have forecasted, some type of recessionary issue. Ironically enough, that didn't happen. And to add insult to injury for those economists that said, well, this world's into a big hurt financially, we're seeing the opposite. For example, the projected GDP for the third quarter of the United States is over 3+%, almost 3.6%. That's phenomenal. Now, what are some of the contributing reasons that happened? Well, one, the tariff fears that the President of the United States implemented didn't have the effect that many thought it would have. While they seemed high at first, the modulation of tariffs and the recession of tariffs, or dropping of tariffs and reduction rather, has had very little effect on the economic growth of these countries. You've also had a tremendous amount of job growth. Now understand, with the implementation of tariffs in the United States, what happened is you have a recapitalization. So redirecting money back into the United States for manufacturing. You're going to have a massive resurgence of manufacturing jobs when these factories go online. And that is going to mean good, moderate to high paying positions for a bulk of people in the United States. So what does that mean? Well, that means we're talking about a very robust GDP. Another thing that we see is that, again, talking earlier about AI, the fear was that AI was a propagated or sort of a puffed up type of investment. Well, sounds really good. Money's pouring in. They're building data centers. It's for ChatGPT, etc. But that's not the case. As I alluded to earlier, over 40% of the revenue in that sector is being driven by people buying hardware, a business buying a computer, individuals upgrading their phone system to keep up with AI technology. The list goes on and on. And that is a revenue stream, because you think about the ripple effect. More computers, that means more manufacturing of computers. More manufacturing means more hardware and technology and tools and parts for computers. So there's a whole litany of individuals that are making money on that sort of consumer food chain when it comes to that kind of construction. The other concern was AI coming online and the loss of jobs. Well, it's actually been the opposite. We've had a massive increase in jobs. Unemployment rates is fairly low, but that has to do with a number of different factors, including being post-COVID. But when you're talking about AI replacing jobs, you're not seeing that. You're not seeing, ChatGPT or OpenAI coming online and thousands of people being unemployed. Now, we can't say that won't happen in the future, but right now what you're seeing is a rededication of tools, i.e. employment, for areas that they need now because they can run more efficient. And when a company's running more efficient, the company's generating more revenue. And when it's generating more revenue, typically the companies reinvest in their growth. And one of the best ways is market share. That means you need more people. You need more bodies. Areas that have been somewhat impacted on AI would be your call centers. You're seeing that. But in the United States, we're not really known for call centers. With that outsourcing that happened years ago, it sort of protected us from that type of model. Therefore, as a geographical location, America is doing very well financially. We've got incredible potential. Also remember, our inflation, while prices haven't come down as low as we like them yet, our inflation's now about 2%. A year ago, we were at 8%. So when you have those factors, it shows that the economy, even on a world scale, is actually more insulated against the things that we thought were going to happen. Even the percentages on the possibility of a recession have dropped dramatically. So what does that mean to you? Well, that means that if you didn't listen to one of our podcasts over the several months and didn't get into the market and didn't sit down with a portfolio analysis team and didn't invest properly, well, you should be doing it now, because the opportunities are always there. But remember, there's a huge difference between timing. We shared these numbers before. 1994 to 2004, the average rate of return in the S&P was around 8%, 7 plus. The average investor did 3%. Why? Emotions. Emotions and logic don't mix. They just don't. If you ever tried to have a logical argument with someone's emotional, you'll see what happens. Same with investing. Investing is a logical, comprehensive strategy. If you want to build a company, it's a logical, comprehensive strategy. The entities that get in trouble with those, building companies or building employment opportunities or building investments, are the ones that use their emotion to guide them. Yeah, I know what the algorithm says, but I feel really good about that. I know what my analysts are saying, but this is how I feel. When you use the term feel and want, and this is what I like, now you're using an emotional reaction to something that just doesn't work. So again, when we talk about investing, we talk about sound investment tools that can be utilized. To illustrate, and again, this is not a guarantee of anything, last year our portfolios that we managed averaged about 30%. Well, the market did about 17 or 18. That's a huge difference. Why? Active management. There was no emotion. logical, comprehensive strategies based on data. Those are key components that make an investment grow. But you have to believe in that. You have to buy into that system. You can't keep listening to a podcast or going online looking for a quick fix and then never doing anything. Remember, you don't want to become paralysis by analysis, reviewing things over and over and over before you pull the trigger. We always recommend get your team together. Whether it's an investment firm, an estate planning team, an estate attorney, a CPA, get your team together and start building a comprehensive model that you can use. Our successful, extremely wealthy clients, we work very closely with and we help build a team because Watch Your Six takes a team, not an individual. So again, those are some of the things you need to think about. If you were to look at the news or go with your emotions and just watch a TV show, you might start thinking, oh, I don't want to invest. I want to leave money in the bank. And people do that a lot. You'll hear people all the time, well, I'm really worried about losing something. I'm just going to leave it in my bank. Well, you've already lost something. We've discussed this before. Last year, you lost 8%. Year before that, you lost 10%. Now you look at the bank account and you go, well, my $1,000 or $10,000 or my $20 million is still there. But did you lose something? Absolutely. And if you want to add insult to injury, imagine those of you that are listening or watching this podcast that invested in a CD. You said, you know what, I don't want to lose anything. I'll just invest in a CD. That way my money's safe. Well, you did lose something. You lost the taxes. Remember, the CD's done. You get an automatic 1099 for that measly 3 or 4%. So not only did your money not grow based on inflation, because the cost of living went higher, now you got hit with a tax on 4% you didn't need. So logic and emotions, as I've said, don't mix. When it comes to your investing, the opportunities are there. The data is showing it. 3 months ago, when everyone was crying about, oh, the tariffs, what happened? Well, many people probably got out of the market, probably blamed a lot of different individuals, but where's the market today? Sure, we have little corrections, what we call sideways capitulation, but look at the numbers. When you hear something on the market say, it dropped 400 points, 500 points, the news loves to amplify it, make it really horrible. Think about that in a percentage perspective. You're talking about a market that's trading around 46,000. 10% of 46,000 would be 4,600 points. We're dropping 500 points. So 5%, right? 5% will put you roughly about 2,000, a little bit over. So you're talking about a 1% to 2% daily swing. It's nothing. Don't get caught up in the emotion. Again, don't let emotion dictate your policy. And also, I love when these economists are online talking about the sky's falling, and then when it doesn't fall, you never hear from them again. So in summation, do your homework. Remember, we talked about it. Do your financial physical. Get all your data points together. Come up with your financial blueprint. Create your outline on how to invest. Ensure that your outline is deployed. Don't let emotion dictate how you invest, and stick to your portfolio or your strategy. Same goes with an entrepreneur. If you're going to open a company and you have a concept, do your pro forma. Get your numbers together. Build your team. Create your SOPs. Create your strategies, create your workflow charts, then deploy those, and then avoid your emotion. Avoid your emotion, again, I'll say that, dictating or making you change your policies or how you act. So those are key components that we think will really help you right now when it comes to what we see going on in the marketplace. So we're going to get into our DMs and our questions in a minute with our side host, producer Grady, and we're going to see what happens. Hey guys, welcome back. This is Jason, Watch Your Six, and we're going to do our Fast Five. We've got some specific points we talked about in previous podcasts, so we want to go through that as well as the current financial data that's going off. Everyone knows about crypto and everybody loves it, but we've talked about in the past our fears. Well, for example, Bitcoin has dipped below 90,000. Now that is given up all of its gains since 2025. So what does that tell you? Well, you got to be concerned. It's the lower price since April, 1 billion in liquidation in 24 hours. That is what we were talking about. That is the concerns always with something, specifically something as fragile as Bitcoin. We also mentioned in our last podcast that Netflix would possibly stock split. Well, it did. We proved ourselves to be right. So it split in February and jumped 23 points. So that's a huge jump that we see, which means what? Well, now it's become more accessible to you. If you don't own a hedge fund or that price point was too high, now you can buy in, and it gives an opportunity for you to really look into that. Some other really good, strong stock splits in the past have been NVIDIA. It was a 10-to-1 split. We have Amazon 20-to-1 in 2022. So stock splits are always a good opportunity for the average investor because now the price point becomes lower. And if you own that stock, well, you might own 5, 10, or 15 times more. So that was great news. Have you ever noticed that burgers are more expensive? Go to the grocery store and notice that your steaks are a little bit higher. Well, ground beef prices and meat in general are soaring. Right now, it shows that ground beef is about up 55% in 5 years. And there's a number of reasons for that. One, that cattle numbers are lower. There's a consolidation in the meat packing industry, which controls, we want to call them meat barons. They have the ability to dictate pricing. So all of those things are contributing to very expensive beef. So if you're in the beef sector, that's good for you. But if you're in the consumer sector, it's bad for us. However, the Trump administration has pledged to bring prices down by 2026. So we'll see what happens there. Now, the penny is gone. So a penny for your thoughts is an old expression because now, as of this last Wednesday, Philly printed its last penny. So there is no longer going to be a copper penny being printed or minted rather when it comes to our mints. And it's been 232 years that we've had a penny. So that's really sort of sad note. The last penny or the last batch will be auctioned off because it's going to be ceremonial. But if you have some pennies, you might want to keep on to those. They may become valuable down the road since they no longer are being minted. And last but not least, Fannie Mae dropped 620 minimum credit score for qualifications of loans. That's a big deal. That means that individuals have the ability now to maybe purchase a home or refinance a home if they have a lower credit score. So we would strongly recommend that you look into it. This is a 50-year mortgage proposed also by the Trump administration. Many have heard about that on the news. We traditionally have 15 or 30-year mortgages. Now they're proposing a 50-year mortgage, which would reduce your payments. But again, I would caution you because there's a lot of interest involved. So you got to know the pros and cons. Anyway, that's our Fast Five. Watch your six. We look forward to talking to you next week and have a great, great afternoon.